The US dollar is not just a currency. It is the backbone of the global financial system. So when the dollar strengthens sharply, it doesn't just affect American consumers or US imports. It creates pressure across the entire world economy. A stronger dollar sounds positive at first. It often signals confidence in US assets. It can attract global capital, and it can reduce the price of imports into the United States. But outside the US, a strong dollar often behaves like a tightening force. Here's why. A large share of global trade is priced in dollars. Oil, shipping, industrial commodities, even many international contracts. So when the dollar rises, countries using other currencies effectively pay more for the same goods. That pushes up import costs. And that can feed inflation, especially in economies dependent on energy and food imports. But the bigger issue is debt. Many governments and companies around the world borrow in dollars. Not because they want to, because dollar financing is often the deepest and most available source of global credit. That creates a structural vulnerability. When the dollar strengthens, dollar-denominated debt becomes more expensive to service. Not in dollars, in local currency terms. If a country's currency weakens against the dollar, it takes more local currency to pay the same interest and principal. That's how financial stress builds. This is why strong dollar periods often coincide with emerging market volatility. Capital begins flowing toward U.S. yields and U.S. assets. Local currencies weaken. Borrowing costs rise. And risk premiums increase. Some countries can absorb this. Countries with strong reserves, stable export income, or balanced external accounts. Others struggle, especially economies with large current account deficits, high external debt, or limited foreign exchange reserves. The pressure often builds in stages. First, currency depreciation, then higher inflation through imports, then rising interest rates as central banks attempt to defend the currency, then slower growth, then, in the worst cases, debt restructuring risks. This is not theoretical. We've seen this pattern before. When the dollar strengthens and global liquidity tightens, the weakest balance sheets show stress first. Countries with large external borrowing needs face higher refinancing costs. Companies with dollar debt but local currency revenues see margins shrink. Even healthy economies can feel the pressure if investor risk appetite turns defensive. And the speed matters. Currency moves can happen in weeks while policy adjustments take months. That gap is where volatility builds. In some cases, governments respond by raising rates aggressively to defend the currency, but higher rates slow domestic growth. They raise unemployment risk, and they can increase political pressure. This is how financial stress becomes economic stress and then becomes social stress. It has happened repeatedly across modern financial history. And it tends to reappear whenever U.S. monetary policy remains tight. Which brings us to interest rates. A strong dollar often aligns with higher U.S. yields. If U.S. rates stay higher for longer, the U.S. becomes more attractive as a destination for global capital. Money flows into U.S. treasuries, into U.S. equity markets, into dollar-denominated assets. That strengthens the dollar further. It becomes self-reinforcing. This feedback loop can drain liquidity from smaller economies. Local credit conditions tighten, investment slows, and growth weakens. Even if the country itself hasn't changed policy. It's importing tighter conditions from the global system. Now, this doesn't mean a strong dollar is always bad. For the U.S., it can lower import inflation. It can reduce the cost of global commodities priced in dollars, and it can strengthen purchasing power. But globally, it often creates asymmetry. The U.S. exports monetary conditions. Other countries absorb them. This is why a strong dollar is often described as a global headwind. It raises the cost of energy. It raises the cost of debt. It increases volatility. And it amplifies fragility in weak balance sheets. So what should you watch? First, watch emerging market currencies. If multiple currencies weaken rapidly against the dollar, stress is spreading. Second, watch credit spreads. If borrowing costs rise sharply outside the U.S., global risk appetite is shrinking. Third, watch commodity prices. A strong dollar can suppress some commodity prices, but energy shocks can override that. And finally, watch central bank positioning. If more central banks are forced to keep rates high purely to defend currencies, global growth slows. The strong dollar problem is not about America winning. It's about financial conditions tightening everywhere else. In a global system where trade and debt are priced in dollars, dollar strength becomes a form of pressure. And when that pressure rises, volatility usually follows.